Thank you for joining us for our COVID-19 update. Our topic today is latest news from the SBA on the PPP loan program. Hi, my name is Lee Schwartz. First of all, on behalf of SBA, we hope you are all hanging in there as best you can. We've been doing our best to be a resource for the business community, and today's webinar is another way in which we're trying to communicate out the latest and greatest information available. Today's presentation will cover everything we know at this point in time. But please keep in mind, this information is fluid and has been changing very, very quickly. Our presenters are going to begin with some discussion around SBA's guidance from last week regarding potential payback of the PPP loan. Then they'll walk you through the loan forgiveness application, which was just released on Friday. If you've been on our other webinars, you know we try to leave time at the end for plenty of Q&A. However, there's a lot of ground to cover today, so I'm not sure how much time we'll have. Later on, I'll ask you to submit questions via the chat function if time allows. If your question doesn't get answered, or if you still have questions coming out of this webinar today and you're an SBA client, reach out to your SBA professional. We want to help. Unless your typical contact is one of our presenters, please don't reach out to them directly. We're trying to make sure we don't have a bottleneck of questions all directed to a few people. Now, if you're not an SBA client, your best bet may be to go to your existing CPA. They know you and your company best. But if that doesn't work, please feel free to reach out to me directly. While our clients are obviously taking up a lot of our time right now, we also want to be a resource for any business out there who needs help. Like many of you, we're an independent Wisconsin-based business, and we need to help each other during these times. In other news, we are recording this webinar today. You will receive an email with a link to a survey, as well as our SBA resource page where the webinar recording will be made available. With that out of the way, our presenters today are Nancy Melberg, Eric Trost, and Dan Glomsky, all principals from SBA. Having said that, I'd like to kick it off to Eric.
Great, thank you, Lee. You guys do a great job, marketing department there, of introducing us and getting us going. We're ready to start the slideshow then. Someone did ask if we have the slides available. Yes, they will be available. Lee will provide something towards the end on how to get a copy of our slides. I want to start talking a little bit about what's happened in the last couple of weeks regarding, the loan that's come out and whether the loan should be repaid or not. There's been a lot of discussion back and forth on, what are the parameters on taking out this loan and keeping this loan when it seems so simple at first. But first, let me direct your attention to the picture on this slide. That is Benjamin Franklin, circa 1918, during the Spanish flu. We have one of the only pictures of him wearing a mask. So you don't get that just anywhere. Anyway, on to the law. When the law was first written, Section 1102, I've included some actual language from the law here, which can be a bit boring, but I think it's important that we point out what this language says because it takes us on a journey of how we've been vacillating in the last couple of weeks. The initial law was written under Section 1102 that said, basically, a small business owner, whether they're able to obtain credit elsewhere or not, can still apply for this SBA loan. So normal SBA rules would be that to get an SBA loan, you have to look at yourself and say, could I get credit elsewhere, and take those other options if they exist. This law specifically waived that requirement and says, we don't care if you can get credit elsewhere. You can still get this loan, okay? So it wiped away a huge hurdle to get an SBA loan, and that is you can get this loan even if you have credit elsewhere or have access to capital elsewhere. Now, the other thing you did when you got this loan is you signed off on a certification that said current economic uncertainty makes this loan request necessary. And so that seems to be for everyone, right? Who didn't have current economic uncertainty when this crisis started? So really what it seemed to be is this loan was opened up to just about any business that met the small business requirements. And with that, a lot of folks applied for this loan. Whether they were small with 1 employee or small with 500 employees, which is still small under the guidelines for this loan, they met the requirements, it seemed like, for the loan. However, the SBA started to do some pushback. So on our next slide, I've put question 31. This was the question that gave a lot of companies pause after they received the loan. Basically, this question was in response to some pushback that, hey, large companies are getting this loan, small companies aren't getting this loan. Who's the large companies getting them? One of the ones that made the news was the Shake Shack, which I'm not familiar totally with what Shake Shack is, and I'm probably borderline on some ignorant hipness here, but the Shake Shack is apparently a chain of restaurants that received the loan. And they are also a public company. And so they got a lot of bad press that how can this big public company receive the loan? They probably met all the requirements of the loan when the law was written at the time, but now the SBA is coming out and saying, wait a minute, if you have access to liquidity, then you really shouldn't take this loan because you couldn't make this certification that you needed the loan, okay? So while the law says access to capital or liquidity is no matter for getting the loan, the SBA came back and said, wait a minute, access to liquidity is a matter in getting the loan. So they put a new bar in place, and this was well after the law was written and folks were applying for the loans. So in this new rule that the SBA came out with, they gave an example. For example, it is unlikely that a public company with substantial market value and access to capital markets will be able to make the required certification in good faith. And really what they did is they started threatening companies with, if you don't make this certification in good faith, it's possible you're committing bank fraud. And what does bank fraud mean? Well, it means penalties, it means criminal action. So they really put a big question mark in folks' mind about, well, what does all this mean now that you put a new test in SBA for access to liquidity? So of course, everyone's asking the question, well, okay, you pointed out big public companies. Does this apply to smaller companies that aren't public companies? So on the next slide is question 37. So this was really helpful from the SBA, right? Basically, hey, does access to liquidity apply to private companies as well? And their answer was, see response to question 31, which was on the last slide. So if you can imagine some bureaucrat writing this answer, do you not think he's giggling to himself? Ha, let me put this one out there. See response to frequently asked question number 31. Not entirely helpful is how I would describe it. And that's probably an understatement. So the SBA knew, I think they still had to address this. And so now they came out with another question on the next slide. So question 39. So they're trying to give a little more guidance here and saying, well, is the SBA going to review these files? And basically the SBA drew a line. This line had not previously existed in the law. There was no above 2 million and below 2 million until this line came out and said, hey, if you have a loan over 2 million, we're going to review it. And when we review it, we'll have some guidance coming out as to how we're going to do that. They didn't give the guidance on this question, but they gave a forewarning that they were going to review any loan over 2 million. And by the way, it's still out there that if you want to pay this loan back, you don't have to go through a review. And you have until May 7th to pay this back. So this was a time period before May 7th telling people, hey, May 7th, you can pay this back and you don't have to go through a review and subject yourself to maybe what could be prosecution because you did bank fraud. Still, this doesn't give us a lot of guidance on, okay, for 2 million and over, what exactly is the SBA going to look at? And so the SBA said, we're going to give you additional guidance. You see it at the bottom of this question. And then what did they say next? On the next slide, they didn't get it finished, right? So they said, that May 7th date, that's now May 14th. So that was the next guidance they said is, well, you have until May 7th to pay it back, but actually now it's till May 14th. And they put this out there because why? They didn't have any additional guidance yet as to whether a company should pay this back or not. Now, finally, they started getting to some real guidance. Next question. And this is where the rubber meets the road, at least partially. A couple things happened in question 46. One is that $2 million line was now said to be, if your loan is under $2 million, then you're presumed to make a good faith representation when you certified that you needed the loan, okay? So if your loan's under $2 million, you can do this and say, all right, they're probably not gonna look at me any harder because I'm presumed to make that representation in good faith. Second thing, if the loan is over $2 million, well, now what's gonna happen? The SBA can review your loan and determine, did you need this loan or not? So now the SBA is coming out and saying, for sure over 2 million, we're looking at the loan and we're gonna make this determination. But they also took the previous prosecution language off the table. They basically said, if your loan's over 2 million, we review it and we determine that you shouldn't have taken the loan because you did not need it. Well, we're gonna ask you to pay it back. And if you pay it back, basically you won't be referred to any other agencies, okay? Which probably means you won't be referred for criminal prosecution if you pay it back. So basically now, with that off the table, which I think was a rather draconian penalty, I think it takes a lot of uncertainty and risk off the table for the business owners that took loans over $2 million. They still have to make the determination. They still may have to pay it back. There's a financial risk to it, but because the criminal prosecution part of it has been waylaid, I think it gives owners at least a little more comfort that we can go at this from a business sense now, instead of having a lot of fear surrounding, if I took this, am I going to be prosecuted? Next slide. So in summary, where are we right now? Loans under 2 million. There's a presumption that your certification was in good faith. So there's really no reason to pay that loan back unless you really feel you didn't deserve it. Loans over 2 million, there's going to be an SBA review. And at that time, the SBA is going to determine, did you need this loan or not? And if they determine that you did not need the loan, they're going to request a repayment. What are our open questions now? So for the loans over 2 million, what factors are the SBA going to consider in making this determination? Are they going to look at an open line of credit or cash in the bank or an owner's liquidity outside of the company? So I think there's still some questions to be answered by the SBA there as far as how are they going to make this determination whether you pay it back or not. And these are important because right now you've got companies with the loan that might say, well, I'm going to pay employees and not lay them off, but I'm doing that with the understanding that I'm going to get this loan forgiven. Because if I knew right now I wasn't going to get this loan forgiven, then I'd just pay back the loan and maybe lay off the employees. So it'd be important to get this guidance out quickly. I don't know that that's coming. Another question is, let's say that the SBA determines that you do have to pay the loan back. How long are they going to give you, before they start other measures to collect the money? Are they going to give you 60 days or 30 days or a year? That's not been issued yet. Another question then is there a challenge process? So for example, if the SBA says, we don't believe you needed the loan and we're going to judge that you should give the money back, what's the appeals process to request the SBA take a second look at it? Will there be a second officer? Is there a second opinion that you can get? Because this could end up being a fight. It could be a large amount of interpretation unless the SBA comes out with clearer guidelines and gives you, lines in the sand. If you had a line of credit over this or cash over that, then it would be a lot more clear. But if it's going to be an interpretive process, then there has to also be a challenge mechanism so that you can get clear interpretations from the SBA as far as how they're going to apply their judgments. So with that, I hope I've cleared up some of the air for you. And I'm going to move along and turn it over to Nancy to talk about more on the PPP.
Thanks, Eric. Boy, I don't know about you, Eric, but I feel a little bit like I'm in a book club, and we meet here every Tuesday afternoon to talk about the PPP book.
This is much more exciting than a book club, Nancy.
Yeah. So, along with this guidance that Eric talked about this certification, we also got some more guidance this last week. Friday, the application was released for the forgiveness calculation. So with that application, the SBA did clarify some things, and actually they added some new things, which I'm going to talk about. And I think a lot of this stuff is actually in our favor. So I'm going to go through some of this. So one of the things was we had always talked about in all of our prior book club meetings was this 8-week covered period began on the day that the loan was dispersed. So if you received the loan on Monday the 20th, then that's when your 8-week covered period began. Well, the SBA now came out with guidance that they are allowing businesses to use this alternative covered period. And what exactly is this alternative covered period? This is a period that the business owner chooses, and they can coincide this alternative period with the date of their first payroll. So I'm going to use the examples as much as I can in the forgiveness application, just so when you're going back and looking at it, you might remember this. So if you received your loan on Monday, April 20th, but your first payroll was the 26th, you could actually choose to begin your 8-week period on that first payroll, the 26th. Now, here's one thing that's very, very important to remember is there are different places in the application where they allow you to indicate the numbers you're using in your covered period or your alternative covered period. You cannot pick and choose which period you want to use. So whichever period you start with or you decide, you have to use that consistently, but only when they say the covered period or the alternative covered period. So I'm sure I just completely confused everyone right now on that. But I think the thing to remember is in the application, there is specific places you can only use the covered period. Even though you're using the alternative covered period, you have to use a covered period. So just keep that in mind. If you are choosing to switch your dates, you want to keep that in mind. So let's see what other fun stuff we have that got changed in here or clarified. I want to bring up, although we don't have an answer for it yet, this time frame. So we did hear that there's been some lobbying to move that June 30th deadline date back, and I have actually heard that it could be as far as December 31st, 2020. I don't believe that's going to happen, but it is possible that they could change that date from June 30th to July 15th, July 30th. And I think the reason behind that is there were a lot of business owners who didn't get in the first round of the PPP loan. So, you know, due to some of the issues with banks or other issues they may have had, they might have gotten in a little bit late. And their 8-week period actually extends beyond the June 30th. So I think in being fair to those businesses, and for some of them through no fault of their own that didn't get their loans in time, it's not fair that they don't get a full 8 weeks. So I think that is the intent in trying to extend this 8-week period. I don't think it will get extended to a 10-week or a 12-week. I just think the end date will extend hopefully beyond June 30th for everyone. So we're going to keep our eye on that, and we'll let everybody know as soon as we hear that. As far as the application to fill out the forgiveness, the application itself in the upper right-hand corner says expires on October 31st. Based on that, our assumption is you have to have your application in by October 31st. Now, a couple things that I want to mention to people. First of all, don't rush to get your application in if your 8-week period ends on, say, June 10th or June 15th. unless you have met all the requirements for the full forgiveness. But if you haven't, and one of those is FTEs, you still have until June 30th, and we're going to talk about that in a little bit, to restore those FTEs. So you want to keep in mind that even though your 8-week period might end June 15th, hold off filling out any application for forgiveness until beyond June 13th in the event you didn't bring all your employees back. Once you fill out that application, 60 days after that, your lender will review the application, and then the SBA has 90 days to approve the forgiveness application. And keep in mind that there is also a 6-month deferral on the payment. So as you can see, as these dates start to add up, you're really giving yourself some time. If you do have to pay any of it back, you know, the clock is ticking a little bit here. So I don't think people will be rushing to pay it back by July 15th. So next slide, please. I want to talk about some definitions that are a little bit different in the application than some of the terminology that we have been using thus far. So you'll see in the application, they say cash compensation. Well, really what we think that is what we have kind of referred to as gross payroll. So really the cash compensation is going to be the gross salaries and wages, tips, commission, vacation, payment of separation of services, which I call severance pay, and then the paid sick leave not covered under the FFCRA. So really it's going to be everything that's going to be included in what I would call their gross wage. They're referring to here as cash compensation. So then they also talk about the payroll costs, and the payroll costs, which are going to be the wages or all that cash compensation, the employer portion of the health insurance. And remember, you have to deduct any of the employee portion that's covered. So if an employee's health insurance is $1,000 a month, the employee is contributing $500, the company is contributing $500. That's the piece that the company can use in this forgiveness. And it's also the employer retirement plan contributions. Again, important to understand, it's not the employee. So it's only going to be your 401k match, your simple plan match for that 8-week period. And the state, the SUTA, state unemployment insurance, can also be included. Now, I realize for most people, because you know, we're already heading into second quarter, that number might not be very high, but still important to get that number calculated. And your payroll provider should be able to provide you that. One thing that I want to talk about too with this payroll is another new concept that we're hearing that we've never heard before, or we've heard before, but we've never had clarification on before. And that's paid and incurred costs. And for a lot of people, that was very confusing, including us, because paid in our world is cash basis, incurred in our world is accrual base. Well, here you're saying cash and accrual. So paid and incurred, what does that mean? Well, we have seen some clarification on this, and this is actually very favorable for people. So what this is saying that if you had a payroll, let me go back to my example of April 26th or even April 20th. Let's say you're using your 8-week covered period and you had a payroll on April 20th. You can use that payroll even though the actual payroll was incurred prior to that, but it was paid in that 8-week. Or the other option that you can do is on the back end of this 8 weeks, if you have a payroll, let's say your 8-week ends on June 10th and your wages are incurred through June 10th, but your payroll is not actually paid to the employees until June 14th, you can actually include that June 14th payroll in your 8 weeks, even though you actually haven't paid it yet, as long as you pay it before the next payroll. So you can't be kind of deferring this and then on the next payroll paying all of it. So you have to pay it before the next normal payroll cycle. So I think this really is going to help people with that tracking of that 8 weeks of payroll. And I think the important thing to remember here is they're allowing you 8 full weeks. So I think that was the intent behind this, was to make sure that people got their 8 weeks worth covered, even if they were a biweekly payroll and they had a payroll 2 weeks after the loan, and then they had a check the day after their 8-week covered period. This is going to protect businesses from that by allowing them to either have that incurred or paid in that period. So I think this was great news on the paid and incurred piece. So next slide, please. So the other thing that I want to talk about a little bit, and Dan is going to go into a little bit of this also when he talks about the actual application. So one of the things that we've heard about, and I've gotten a lot of questions about over the course of the last several weeks, is FTE. How do you calculate an FTE? So there has been really good clarification on this in the application, and they're actually offering 2 ways to calculate this. Something they're calling a simplified method, and something that they also is the actual calculation. So the actual calculation is going to use a 40-hour work week. So you're going to divide the total hours in that week divided by 40, and that's going to come up with your FTE. The simplified method is going to be any one individual at 40 hours is considered 1 FTE, and any individual under 40 hours is going to be considered 0.5. Now, you have to apply the same method in your look back period as your covered period when you're doing this. So this is going to be very important. Now, I think people are going to want to calculate this 2 ways, because if you have a lot of employees that are at, say, 38 hours, 39 hours, you're extremely close to the 1.0, but you're only going to get 0.5 for them if you're using the simplified method. So I really think the simplified method isn't necessarily going to be the right way to go for businesses unless they have a lot of part-time employees who are hovering around 20 hours or less. Otherwise, I think you're probably going to want to do just the calculation of total hours divided by 40. And keep in mind that any individual cannot be more than 1.0. So you're always going to have 1.0. So you're going to look at that 8-week covered period, and you're going to calculate that. And then your base period, you have some options here. So your base period, or what I always refer to as the look back period, is going to be February 15th, 19 to June 30th, 19. So you're going to go through the same calculation you went through above to calculate that number in that period. Or you can use January 1st, 2020 to February 29th, 2020. So you're going to want to use this if you're a new business, or you already had some reductions, because keep in mind, you're going to be comparing the 8-week period to this period. So you're actually going to want to use the lower FTE count in these 2 periods. And then of course, if you're seasonal, you even have different options. So you have this consecutive 12-week period between May 1st, 19th and September 15th, 19. So now we're going to look at actually some exceptions to that, and then we're going to look at the calculation as quickly as I can go through it. It tends to get a little bit complicated. The FTE reduction. So I got a lot of calls from clients saying that they have made the offer to their employees to come back to work, and their employees said, why do I want to come back to work when I'm getting an extra $600 a week on unemployment? I don't want to come back. Well, that's not really fair to the business. So they have come out with this exception to the FTE rule that if you have a written offer to rehire your employees back and they rejected that offer, you would not be penalized in this FTE reduction calculation. They have also gone one step further and said that if an employee was fired for cause, voluntarily resigned, or requested a reduction in their hours, you would also not be hurt in this FTE reduction. So this is an exception to your reduction of FTEs that, again, I think extremely favorable to businesses. So I think they've done a good job with this clarification. So then we also have this, what we're going to call a safe harbor reduction, where if the borrower reduces their FTEs between February 15th and April 26th, and they restore them no later than June 30th of 2020, there is also no reduction in the FTE calculation. So this is kind of why I was mentioning before about maybe not wanting to fill out your application too soon, because if you had 15 FTEs in your look back period, you now have 13 FTEs. You still have till June 30th to get 2 more of those FTEs on board and not take a hit in the reduction. So now we're going to look a little bit at the calculation. So the way the calculation works, and I really don't want to go into too much detail on this because it can be a little bit complicated, but I'm going to try to explain it. So this is a reduction in the wage. So there's this 25% rule, and I'm sure you've heard about us talk about it in other seminars that if you reduce an employee's pay and they are below 75% of where they were, there's going to be a reduction in the calculation in the forgiveness. So the one good thing that we have learned in this is that this actually relates to their actual hourly wage or their calculated hourly wage versus the total amount of payroll in these 8 weeks. So I'm going to try to break it down a little bit. Let's say you had an employee and you have to look at the first quarter average hourly rate. That is the look back period in this calculation. Again, we have a lot of different look back periods, so this is where it gets a little bit confusing. So in this look back period, it's the first quarter. So you're going to calculate their average hourly rate of pay in the first quarter. And then you're going to take that amount and you're going to multiply it by 75%. That's the amount, whatever that calculation is. So I have an example here that if I had an employee in quarter 1 making $25 an hour, if I calculate 75% of that, it's $18.75 an hour. If I reduce their hourly rate below $18.75, then I have a little bit of an issue. So let's say I reduce them to $18 an hour. So now I have between $18.75 and $18, I have a 75-cent reduction from my look back period to my average in my 8-week covered period or alternative period. So then I have to take that 75 cents and I have to look at the total average hours worked in quarter 1, and I have to multiply that by those hours by that rate to get my total reduction. I know this is very confusing, and we do have worksheets that we can help people with to calculate this. The application actually gives you step by step, and Dan's going to go through that a little bit. But I think the whole idea here is just conceptually that you don't want to reduce anyone's average hourly rate in this cover period by more than 25%. I think that's really the moral of the story. And I think as long as you've done that and you've kept your FTEs where they were in that look back period, I think that's where people are going to have some pretty good results in their forgiveness calculation. And again, we can certainly help people with any of that information. So hopefully I didn't confuse anyone too much on that. I think those are all the definitions that I want to go over. Next slide, please. Yep, so now I am going to actually turn it over to Dan to talk a little bit about the actual application forms.
Thank you, Nancy. That was a great job. I think obviously there's a little bit of confusion as far as, what do some of these terms mean and how do I apply them? And so, the intent of this webinar is really to present the terms, get you introduced to them, then kind of walk through the application and try to figure out exactly, where in the application we need to apply what. So we're going to start with the general concept of what the application is. Quite honestly, the form in itself are very, there's 4 pages that you would potentially need to complete. They seem pretty straightforward from the calculation perspective, but it's these behind the scenes definitions that you really want to pay attention to. And that's where we really make our determinations. If I were to say the most critical component in this calculation process is really the FTEs. So if you do have a reduction in the FTEs, you have to really address that and see what you can do to try to improve it. Because we talk about salaries or wage reduction, but that is on an individual employee basis. Whereas the FTE, if you reduce your employee count by 25%, that's 25% of your expenses that are not going to be allowed for forgiveness. So it has the most impact. So as we kind of go through things, that's one thing I want everybody to kind of focus on. The loan application or the forgiveness application itself is, it has some basic information, the loan number, the loan PP, a loan amount. They also ask for the number of employees at the time that you filed for the loan and the time and the number of employees that you have at the time the loan you're making the forgiveness application. Both those numbers are not used anywhere in the calculation, but are part of the application. So you want to make sure that, you're kind of tracking those dates along with the other ones that Nancy mentioned. The other critical piece is you're going to identify your covered period, and that's the date you got the loan and the date that, the 8 weeks after that, and the alternative date that you might be applying to the calculation. There is also a question on there whether your loan amount is below $2 million or exceeds $2 million. And there's a box there that you would check if you're above the 2 million. Obviously, you don't want to check that if you're below it. We believe that that's obviously an area where the SBA is going to have as a data point, and certainly becomes part of the audit population. So I would hope that if you checked it and you're below that, you still wouldn't get audited, but it might kick you into that chain. So just be kind of cautious as you go through that. The application itself is the main application form, which is what I have identified, number 1. Number 2 is there's a PPP Schedule A form, which captures the payroll cost, and then the PPP Schedule A worksheet, which supports those payroll costs. Then they have this optional PPP borrower demographic information. This is an optional form, and it's part of the program, and it's really kind of intended to capture, whether somebody's disabled, a veteran, and it's more of if you're one of those individuals and you're making a forgiveness application, I might suggest you complete it if you're willing to, because what I think it does, it helps the government feel better that they're helping out the vets and the disabled and not the, large LA Lakers and that type of thing. So it really kind of, is, I think, the opportunity for the program to say, oh, see all the people that we helped. But it is optional. If anybody asks you to prepare it, you don't need to do it. And then there's the other piece is that when you make your submission to the bank, and that's who will be reviewing or making your approval, and they have 60 days to do that. You need to complete at a minimum number 1 and number 2, which is the main form, and then the supporting payroll cost information, which is Schedule A. All right, so then the drive a little bit deeper into the payroll cost, the PPP Schedule A form. That is where it breaks it out into basically a multiple of categories. The first one is going to be Table 1 employees, which are employees that are less than 100,000. And as I said before, Schedule A collects its data from Schedule A worksheet. So, but the components are basically you start with the Table 1, Table 2, which are basically the employees, and then it goes into the health insurance or retirement, and those employee costs. And then it has in there owner's compensation. And owner's compensation here is limited to $15,385 per owner. And the critical part here is that right now the health insurance and the retirement plans, it's very conceivable that the owner's portion of those health insurance and retirement contributions are not able to be part of the calculation or the forfeiture. We expect some guidance to come on that because we don't necessarily know if the statutes really intended for this type of application, meaning that if you're an owner of a business and you had health insurance, that health insurance cost is not forgivable under the loan. At this point, the application certainly seems to appear that that is the fact, but we're going to hold some reservation there at this point and see what plays out. Then from, so that's part of where we go through. Then from there, we want to consider the FTE reduction calculation, which comes from our Schedule A worksheet. Just a little bit more on the Schedule A worksheet is that Table 1 I talked about had less than $100,000 of wages on an annual basis in 2019. So all employees that earn less than $100,000 need to get put on Table 1. And Table 1 lists out each employee separately, and you have to calculate whether that employee has any reduction in pay between the beginning of the year and your 8-week covered period. So that's one thing that you want to, there's quite a bit of detail with respect to that calculation. And also in that Table 1, you determine whether a person's a 1 or a 0.5 or a 0.7, but basically what are they in the full-time equivalent scale. Table 1 also includes those employee counts of individuals that have not, that you made an offer to come back to work and they decided, nah, I'm going to stay on unemployment, or I don't want to come back, that type of thing. So if you have those, you want to make sure you document them, but that employee count goes on Table 1 and it's going to get flowed through into Schedule A when you work the numbers back into that. Table 2 is for all employees, again, greater than 100,000. So again, it excludes owners, but anybody that made more than 100,000 in 2019 needs to go on Table 2. Again, it's the question is whether, maybe they were at 100,000 in, 120,000 in 2019, but now they're at maybe 90,000. The reality was, I think that belongs on Table 2 at this point, recognizing it's below the threshold of 100,000. But keep that in mind. So then we have the non-cash, and again, we mentioned health insurance, payroll, and our retirement. Then we have non-payroll costs. And these are the costs that we talked about, and they are not allowed to exceed 25% of your total loan proceeds. So if I received 100,000, I can only spend 25,000 on these items. And these items include mortgage interest. When we say mortgage interest, we're not just talking about real estate. We're talking about personal property as well. So if you have a personal property, that machinery equipment that is secured, and there's in essence a mortgage on that property, that interest is allowable to be included in this non-payroll cost. Same thing with leases. If I'm leasing a real property or a personal property, I can include both of those payments. Now, these leases have to be in place before or as of February 15th of 2020. So you can't like, oh, I got, a related party, I'm going to write a lease and we're going to get some rent for some property. Those things we got to make sure we go back to February and be good about that. Utilities, electric, gas, water. Now we say transportation. Transportation in this case is a transportation utility cost. There's some states that have those in exchange for maybe electric or gas. So we believe that that's the intent of that provision. Telephones, we believe cell phones include at this point. Internet access, all those things are included. And the other piece that's of note here is that paid or incurred during the covered period. The important part of all these expenses is that you've paid them. So you have to pay them in the 8-week period. when I get to the documentation requirements, you have to make sure that you have invoices and proof of payment. So you can pay whatever you pay in the 8 weeks is qualifying, right? You also have the option if something is invoiced during the 8-week period, but it falls out of my 8 weeks. So I paid this week, or I got the invoice this week, and I pay it next week. I can potentially pull that back as long as it's in its regular billing cycle date that I'm paying it. So basically it was incurred, but now I'm paying it outside of that 8-week period. I can still pull that back as long as it's part of my 8-week period. All right, so then next we have the actual calculation itself. We take that data that we collected from the payroll and the non-payroll costs, and then from there we subtract off any reduction in wages that we had. So if I reduce the salary individual, I might have to include a component for that. If I reduce somebody's hourly rate, I might have a calculation and include that. But that gets included in the calculation. Then from there, you take the combined, you have to take the smaller of the 3 possible calculations here, which is you combine the cost less the reductions multiplied by that full-time employee equivalent percentage. So if I reduce like I said, my labor force by 25%, I now have to reduce my cost less my reductions by 25%. And that would be one number. Then it looks at the PPP loan amount or the payroll cost divided by 75%, right? So if I can only spend 25% of my loan costs on non-payroll costs, then as long as I stay below that 25, that last number C doesn't become an option. But if I use 30%, well then that's going to kick back into the calculation. But more than likely, I think you're going to see that A is going to be your number, unless some people applied for a loan and took a lesser amount. So then we have the representation and certification. And the important thing here is that you can't make false statements on this report or this application. I have 5, 2, 5, there's even a 13-year potential imprisonment. So I don't want anybody to obviously go to jail for trying to get a little more out of their forgiveness application. So keep that in mind. It also, in this part of the certification, that you're certifying that owner's compensation will not be larger than it was for 2019. So if an owner received $50,000 in compensation in 2019, they're not able to go and claim $100,000 in 2020. They have to stick at that $50,000, and you're going to certify that you've done that. And it's also, you should be understood that any representation and certification that you're making, you're also saying that you're going to turn over any information to SBA that they request. If you fail to do that, they can either deny your loan approval or deny your forgiveness. So those are kind of important consequences. And then we want to get to documentation, and there's some information that has to be provided with the application itself. And I guess the core of this is really this backup support to some of the critical numbers. Obviously, we're looking at things that are being paid within that 8-week period. So proof of payment is a critical component to this. They're also looking for payroll tax returns. Again, under penalties of perjury, you're filing these payroll tax returns. So again, it's another validation of the numbers and gets the accounts where they need to be. We're also looking at full-time employee or full-time equivalent in documentation. And we're looking at, all those various periods that Nancy talked about. We have to have documentation behind our supporting calculation. For the mortgage, again, proof of payment. For the rental and utilities, there's one other piece that's not on this slide that you want to be aware of, is they are asking for proof or an invoice from February of 2020 that showed what your rent was, your personal property lease might be, your utility bills. So again, it's not, they're collecting information that prevents you from saying, oh yeah, I had utilities of 20,000, but in February I only had 5,000, right? So there's checks and balances here. The other piece is there's documentation that's expected to be retained and pulled together, but not necessarily provided. And that is really all the supporting calculations that you have for Schedule A worksheet with respect to wage reduction, you know, the employees that chose not to continue to work with you. So if you, again, you had an offer letter out to somebody, they rejected it, or somebody voluntarily resigned, all that information needs to be retained in your files for up to 4 years. So keep that information in mind as you go through the application process. So that's what I have for you guys as far as that. And I think we can open it up. I tried to leave a few minutes for some questions here. Have at it, Lee.
Thank you, Dan. Nancy, Eric, you guys did an amazing job of running through a lot of information in a short period of time. So we have already received probably between 50 and 75 questions.
And I've already answered several.
I know you have. So keep them coming. But guys, while, so let me just quickly state, I will continue to read them as they come in. I'm doing my best to kind of aggregate them as there are some kind of themes that I'm seeing. So open up the chat function in Zoom, address your question to all panelists. We only have a few minutes, so we'll do our best to kind of hit on the high points. But guys, a few of the questions, really multiple questions are coming in about how these are handled, how these calculations should be figured as it relates to owners and shareholders of businesses. Can you guys talk a little bit about how, you know, depending on their business structure, how those should be calculated?
Sure. I guess I'll start. So if this is an S corporation, you know, basically an owner is going to get a W-2. So you're going to include, if the owner gets a W-2, you're going to include that W-2 wage in the calculation, just as you did for all other employees. So there's nothing different about an employee. I did see a question asking if dividends or distributions were included in that. No, they're not. It's going to be the W-2 wage. However, if you are a partner in a partnership or you are a sole proprietor, then you are actually going to use the forgiveness calculation for them is actually pretty easy. It's 75% of their 2019 Schedule C or K1 income. So, you know, I'm not sure how we're going to provide that, but we are recommending to people that they actually pay themselves that money, because it does say paid to partners and sole proprietors. So we recommend that whatever that 75% is, you want to make sure you actually pay yourself for that.
And Nancy, can you also clarify on that? We got a question in that said, you know, I thought it was $100,000 max, not the, you know, the $15,385. And I think they're referring to an owner on there.
Yeah, so, yep, that's a great question. It is always going to be capped at $15,385 because it's always $100,000 annually. So even if you were a partner in a partnership and let's say you only have 2 partners and you made $400,000, each partner is going to be capped at $100,000 and then equated to, in that 8-week period, $15,385.
Yeah, the math on that is pretty straightforward. It's $100,000 times 8 divided by 52.
Correct.
That's where the 15,385 comes from.
Or divided by 52 times 8.
No, you have to do it the other way.
You guys, all right, getting into some mathematical equations. Talk a little bit about, we've got a lot of questions coming in about different ways to compensate employees right now. There's questions about overtime. Is that included, hazard pay, and even bonuses paid during those 8 weeks? Can you guys address whether or not those are included in the forgiveness?
So I'll take this one. At this point, certainly paying an employee more during this process is not problematic as long as you're not pushing them above that 8-week, you know, equivalent of the 15,000, whatever the amount ends up being. But you can increase somebody's pay. You can pay them bonuses, you know, and that type of thing. So we're not seeing anything at this point that would go against that. What I do want to caution everybody on is the fact that, you know, this is the application process. The application refers to further regulations that might be published. So there is going to be more guidance. There's going to be more clarification, and there's going to be things that are going to twist and turn as we get to the final leg of this. So be prepared for that. So what my word of caution would be that I'm good with the, you know, you're going to pay somebody, you know, hazard pay or whatever the case may be for coming to work. If you're going to, you know, go and try to pay, you know, related parties, put them on payroll or pay somebody bonuses, you know, these are things that potentially could result in a regulation that reverses the advice we're giving today. So if you're going to do them, make sure that you're okay if they're not forgiven ultimately, because that's probably the biggest concern when we you know, kind of put on these webinars.
And Dan, I want to add to that, you know, that was great clarification. And I want to add to that because I seem to be getting a lot of questions about profit sharing contributions, that a company may at the end of the year make a decision to pay a $50,000 profit sharing, and it has to go through testing and it determines who gets what. And a lot of people are asking, can I pay that profit sharing in that 8 weeks? We don't really have the answer to that. My gut is telling me that that might not be a forgivable thing because you really don't even know at that point in that 8 weeks what that profit sharing is going to look like. However, I think exactly what Dan said, if you knew that you were going to possibly do that at the end of the year anyway, then I think you could do it in that 8 weeks. But remember, it's only going to be 8 weeks worth of the annual calculation you would have done. So if you would have done $52,000, you're going to get $2,000 of that. And it needs to be paid. It can't just be accrued. So keep that in mind. If you were going to do it, okay, but it might not be forgiven.
Okay, real quick, I know we're running out of time here, but we've also had some questions about the proper accounting treatment for the forgivable portion of the loan. So is that, or will that not be treated as taxable income?
Yeah, I'll take this one. Currently, that's not taxable income, but the flip side of that is the expenses are not deductible. So when the law came out, the law specifically said that the forgiveness was not taxable income. Then the SBA came around, or the IRS in this case came around and said, well, that's fine if that's not taxable income, but the expenses then are not deductible. In effect, that wiped out the advantage of the loan forgiveness not being taxable income. Having said that, there is a bill currently that the Democrats did pass called the HEROES Act that reinstates the, when I say the Democrats, I should say the House of Representatives passed it, that this bill reinstates the deductibility of those expenses, which would then revive the benefit of the PPP loan forgiveness being tax exempt income. That HEROES Act, though, is likely going to be negotiated out for this next round of stimulus. And while I think that that provision is going to survive the negotiations, don't know for sure. And so where we are right now is those expenses are still not deductible. But if that provision does survive in this next round of stimulus, then the expenses become deductible again. And then you truly get the benefit of having the loan forgiveness be tax exempt income.
Okay, thank you for that, Eric. As we wrap up here, I'm just curious, and maybe Dan, this is for you, but just again, very quickly, what should people be working on between now and the time the forgiveness application is due?
Yeah, so I think that's a great question. But as I said before, the FTE, you want to make sure that you don't have a reduction in employee count if at all possible. You want to make sure that you're documenting, if you made an offer to somebody that they rejected it. So really, know what your full-time equivalent employee analysis looks like, map out your expenses, and really just kind of stay on top of it. Don't wait until the end to try to say, okay, my 8 weeks are up now. I'm going to make my forgiveness calculation and I'm going to apply for the application for forgiveness, because you might lose out on some opportunities there. So again, my strategy is really to really want you to promote the planning and being prepared for what the numbers are going to tell you.
Okay, thank you. Thank you all. Well, I think we're gonna wrap up here, but I would like to let everyone on the webinar know that SBA has created a resource page where the recording of this webinar and the slides will be located, as well as additional information and updates on COVID-19. So bookmark svaccountants.com/COVID-19 as a resource for you and your business. Our plan right now is to offer additional webinars when needed, but instead of kind of planning them out a week or two ahead of time and risk them not being timely, we're just gonna schedule them when new information warrants it, and we'll get it out there. So please stay tuned. You know I've said this before, but I'd also really like to thank Nancy, Eric, and Dan, and really the entire SVA staff for working so tirelessly to provide information to our clients and really the entire business community. There has been a lot of conflicting information out there, and the direction that you guys have been giving on these webinars has really been confirmed once the official guidance has come out. So anyway, big shout out to you guys. You guys have been amazing.
Thanks, Lee.
I'd also like to remind everyone on the webinar that the SVA team is only a phone call or an email away. So if you're a client, reach out to your SVA professional as questions arise. We have several hundred people on this webinar right now and just as many questions. So please reach out to your typical contact, not the presenters, so we don't have a bottleneck of questions to address. If you're not currently an SVA client, please contact me, Lee Schwartz, so I can get you the help or the answers that you need. Again, we are here to help. Thank you again for joining us today. Hang in there and be well.